In the investment world, when everything moves down at the same time, what do you do? Well, you've got to avoid these 3 mistakes. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so one of the things that's made investing in 2022 unusually challenging is that everything, all investments, seem to be moving down at the exact same time. Now, we've all learned and believed the idea of not having all of our eggs in the same basket, right? And the big idea with diversification is that not all those things are going to move in the same direction at the same time. And that means if you're following a disciplined, diversified investment strategy, you're always going to be upset with some of your investments. That's something for my 20-year career, it's been difficult to remind clients of, because when the market's going up and they've got some pieces that aren't going up, to remind them that, well, that's how diversification works. The challenge is on the opposite side, though. When the stock market's going down, when the U.S. stock market's going down, it's challenging to also see the international markets going down, see the real estate market going down, and see bond investments going down. This is rare that everything's going down at the same time, but what do you do during these challenging times? I'd first say this is one of the reasons, although this one's a little bit unique, but one of the reasons why we recommend a diversified, not only just diversifying your investments, but diversifying your investment strategies, okay? Using multiple investment strategies. Because typically when you want diversification to help the most is during times of crisis. During times of crisis, all investments, basically investors go risk off. They don't want to hold anything except for cash, and whether it's US or international, high quality or whatever, growth, whatever, the stocks all tend to go down at the same time, okay? And then during that crisis, gold will go down, bonds will go down, basically all investments will go down during that crisis, which is really when you want that protection that diversification offers, when you want that the most, and it typically fails, which is why we recommend having multiple strategies. Yes, one that is based on diversification, buy and hold, low cost, high quality investments, but also another strategy that can adapt, a momentum strategy, or one that has some hedging to it as well, okay? So that's typically what we recommend. We're not seeing crisis right now. This is not crisis. This is a unique time period where really the past 7 months, investment stocks have gone down, US and international, high quality and low quality. Yes, value, high quality has done better, but it's still negative. It's still down year to date. And the worst part is that that is combined with the worst year in the bond market ever on record, okay? And now that's the bond market index, which has only been around for about 40 some years. And so anyway, but just bonds down 10%, stocks down double digits as well. What can you do? Well, I would argue, okay, you've got to avoid these 3 mistakes and have the long-term perspective that, yeah, this is unusual, doesn't happen that often, but it's not permanent, okay? It's not going to rain forever, okay? During these seasons, investors are prone to make 3 common mistakes. And the very first one is you're prone to be sold a product. And you've got to watch out for that, because at times like these that have lasted a long time and everything's going down at once, the allure of something that's going to provide a guaranteed return sounds so appealing. And it's times like these right now where you've got to avoid being sold something, because when that happens, yes, the G word does sound very appealing, but you give up a lot when you transition out of the traditional markets and go into something that has a guarantee. You give up lots of flexibility, lots of long-term future growth at typically a time when you shouldn't do that. So investment salespeople, this is a ripe environment for them, okay? Oftentimes being sold a specific product that has a certain guarantee, a guarantee set of returns, a guaranteed set of outcomes, that can sound extremely appealing during these times, because you look and say, well, I am not getting positive returns in the market right now, not getting positive returns in the bond market right now. Everything seems to be going down. At least I'll get some sort of positive return. And what we've seen with that is typically once you get into those sorts of tools, you can't get out of them. There are penalties and there are other features where you can't really get out of them, and you're stuck with those for the rest of your life, and you give up lots of flexibility. So that's the first mistake that I would tell you to do, or to tell you to avoid when everything seems to be going down. Be watchful, be careful about being sold an investment product. Second thing, and this goes right along with it, is another mistake is people say, well, at least I can't lose money in cash, therefore I'm going to change my strategy. That's the key point. I'm going to change my strategy. I'm going to get out of that and move into cash. Here's the issue with that. Well, if the market does continue to kind of shrug forward, down over the next few months or even next year, gosh, we all wish we were in cash, right? However, normally when you make that transition, you're not going to transition back into the markets until it feels safe again. The market's going to bottom well before it feels safe. And here, if you haven't been an investor for that long, or you suffer from what we all suffer from, and that's investor amnesia, where you have recency bias. You can't remember what happened even 2 years ago, 3 years ago, 4 years ago. I've been doing this for a long time. I've seen a lot of these. When the stock market bottomed in March of 2020, I did a video that day, and I actually said, I don't think this is the bottom. We'll see. It didn't feel like the bottom for 6 months or 7 months, and we'd made back all of the losses that we'd had. Same thing happened in 2009. No one expected that the market was going to bottom on March 9 of 2009. No one expected that. Okay, and so typically, if you have a strategy that's automatically and unemotionally pivoting things into cash or lower risk, fantastic. They're not perfect, by the way, but that's a momentum type strategy. We offer those as well. However, if you say, I'm going to make a change and grab the wheel and shift things into cash, you're not going to shift things back into the market until it feels better. And oftentimes that's very late. And what I've seen, guys, is oftentimes people say, well, now I can't buy in now because the market's way back, a lot higher. It's going to drop again. Trust me, I'll wait until it drops again and then I'll buy in, and then you're sunk. Okay? So be careful about that second mistake when everything seems to be going down, of grabbing the wheel and moving everything into cash. And then the third big investment mistake that people make when everything seems to be going down is they then turn to speculation. The first one is falling for a guaranteed product that you get into and you can't get out of. Okay, you got to be watchful for that. Second is deviating from your long-term investment perspective and plan and just shifting into cash. But this third one's doing the opposite. It's, well, I've seen some losses. Now I've got to make those back really quickly. And so instead of sticking to a tried and true investment strategy, you pivot into something more speculative where you can try and get some real quick gains. The problem with that is some of those can hit home runs, but if you don't hit a home run, you're going to strike out. And therefore, you put yourself even in more danger and more risk by shifting to something that's much more speculative, that doesn't have a tried and true evidence-based history to it, right? And you have the potential to cause even more financial damage than just waiting through this unique time where everything seems to be going down at once. So I would resist, and I've been there, guys. I'm down 20%. How can I make that money back really quick? Okay, because being back up where my portfolio was, I was able to achieve certain goals and I felt better about my financial future. How can I make that money back really quick? Can typically cause you to take more risk or additional speculation that will cause potentially even more financial pain. So those are the big risks when you're facing a stock market or an investing climate like we're facing right now, where it doesn't matter really where you turn. It seems like everything has gone down at once. The big idea here is those times are more prone for mistakes than other investing times. Normally, when the stock market's riding high and doing well, maybe the big mistake you make is taking too much risk or thinking it's gonna last forever and taking more risk than you really should. But right now, those three mistakes, falling for an an investment trap, something that that has some allure to it, and you abandon your principles, you abandon your strategies to go to cash, or you get speculative. Those are the three main risks you need to avoid. How do you avoid those? Have an investment strategy that is designed, that's connected to your overall financial goals and your risk tolerance, that performs well when the markets are doing well, but also has defense attached to it, so you're not going to abandon or second guess your strategy when investments are going down, okay? To us, so what is your overall investment philosophy and your overall investment strategy? That's the thing. Now, when markets are down, maybe it's a gut check, but it really should be, listen, we assumed moments like this and environments like this were going to happen. That's why we've been using this plan. Is it perfect? No. However, we're using this strategy because it works when investments are going well, and should help us navigate and ride through challenging times as well. To us, that is a diversified mix of high quality, low cost investments coupled with a momentum strategy, maybe even a hedge strategy as well. Something so you've got multiple strategies that if we do and when we do see that crisis, you've got some of your dollars that aren't moving with all of the other baskets that are now started moving together. So work with your certified financial planner. Make sure you've got a tried and true investment strategy for the long term, that you don't deviate it and you avoid those three main investment risks. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.